Hey, I hope you're doing well. If I show you this, do you understand what you see? Or at least are you capable of identifying the underlying market trends? If not, or if you're curious, stay with me for a bit. I want to review the basics of market evolution. This is particularly interesting when creating your own trading bot, since the possibility of detecting certain market features can lead you to very profitable trades. Enjoy! There are a lot of features that you can spot in a candle chart. And little by little, I will get into more details in future videos. But today I want to talk about the basics, which is what I call market components. Essentially, what I want to show you is that the main trends in a candle plot that you can see can be decomposed into four components. The high frequency changes of the price of the asset, which is coupled with three trends: a downward trend, a sideways trend, and an upward going trend. Let's move on to our first component, which is volatility. Volatility is a statistical measure of the dispersion of an asset value. If you're more mathematically minded, you might guess that it is defined as the standard deviation of the asset value. Well, not quite. As you can see in this formula, the volatility is generally defined as the standard deviation times the square root of a period that you're considering. In other words, volatility will differ on the period you're looking at. For example, you could define a daily volatility, a monthly volatility, etc. In more practical terms, volatility characterizes how much an asset value oscillates around its mean value. Often, volatility is generally interpreted as higher risk. Why is that? Well, because it leads to a loss of predictability. I can give you a simple example. Say, for example, today you've bought $1,000 of Bitcoin or a given asset, and tomorrow you want to sell that asset to buy another one, for example, but because of volatility, the asset value decreased by 20%. Then that could be a big problem. Another example would be, imagine you have invested in a high yield stock or ETF, and you're relying on this monthly income for your daily expenses. And because of volatility, the next month, the price value dropped and therefore the dividend as well. And then you can't use that as you wanted to, and that could be a problem. Now, from a trading perspective, it can actually be seen as a good thing because this is what will give you a lot of possibilities to buy low and sell high. Now that we know what volatility is, what I want you to understand is that basically any market evolution is based on three market trends, which will be the coupling of volatility with an upward going trend, volatility coupled with a downward going trend, and volatility coupled with a sideways going trend. So now what we're going to do is spend some time to study how to spot and characterize these trends, as this is really key when you're creating strategies and trading bots. Let's move on to the first one. That's the bull market. So what characterizes a bull market is a market that is on the rise. In other words, that is characterized by a sustained increase in prices. This is a typical example of a bull trend, where you can see that the underlying trend goes up and you have the oscillation around it because of volatility. So what are the key features? Well, on average, you will have generally more green candles than red, and the green candles will be in general larger than the red ones. But really, the key feature that characterizes a bull market is that you have higher highs and lower lows. Let me show you here. For example, this high is higher than the one before, and this one is also higher than the one before. And the same for the lows. This low is higher than the one that was before, this low, etc., etc. The higher highs and the higher lows are really the key feature that characterize a bull market, and therefore what you could put into a trading bot to detect such a market. Now, with the power of AI and machine learning, I can see some interesting projects where you use these tools to detect such a market. The economy behind a bull market is generally favorable and therefore growing, and that's why you have the increase of your asset price. In consequence, the investor psychology is generally positive, where people invest, buy in the hopes of obtaining profits. Typically in the jargon, you might hear that someone is bullish on something or you are bullish on something. This means that this person believes that this thing will keep on increasing or will start increasing in the near future. Let's move on to the opposite market, which is the bear market. What characterizes a bear market? It is a market that is on decline, that is declining. And generally, we say that a bear market starts when price starts falling from 20% of its recent highs. Here's a typical example of a bear market where the underlying trend is clearly going down and you have its affiliated volatility on top. What are the features? Well, as opposed to the bull market, you will generally have on average more red candles than green, and the red candles will be in general larger than the green ones. But really the key feature that characterizes a bear market is that you have lower highs and lower lows. Same thing reverse from the bull market. What you can see here is that this high is lower than the high that was before. And the same for the lows. You can see that this low is lower than the low that was before, that was around here. Again, the lower highs and lower lows are really the defining features of a bear market. And this is what you could use in a trading bot to detect a bear market, for example. So as opposed to the bull market, the economy in a bear market is discouraging and on the decline. As a consequence, the investor psychology tends to be negative, with people who tend to sell more their position than buy them, which in terms fuels this declining of your market. In terms of jargon, if you hear that somebody is bearish on X, that means they believe that X will carry on decreasing or will start decreasing in the near future. Let's move on to our last component, the sideways market. It is a market that is moving horizontally on average. Here's a typical example. So what are the features that characterizes it? Well, it is a market where the asset value will oscillate between two extrema that you can guess around here. In other words, the highs seem to bounce off the same level and the same for the lows. So in terms of trading bot, this is a really good opportunity to turn on your grid trading bots. In this case, the investor psychology is indecisive. What happens is that you basically have as many people feeling bullish than people feeling bearish. And this is typically what we call a period where the price is consolidating. And that is why I chose this drawing to represent the sideways market. Okay, let's test ourselves and see if we can spot the different trends in this chart that I showed you in the introduction. So the first section here, you might have guessed, is a consolidation as the price is moving horizontally. Then we have a big drop, so that's a bear market, which is then followed by a bull market. Then we're back to a little period of consolidation, which is followed by a huge bull market, itself also followed by a huge bear market. And then we finish by a bull trend. Let me zoom on this section here. I want to highlight something about volatility. When you're looking at this section, you have this sort of higher amplitude volatility, but you could zoom in even more and look at these changes, and you would say that the volatility is such. This was just to highlight that depending on the period that you're looking at, the volatility is different. This was Louis at Robot Traders. I hope you enjoyed this video and that it will be helpful for you in the future. Don't forget to give us a like and subscribe to the channel. If you have any thoughts or comments, don't hesitate to write them down below or join our community Discord. Until next time, take care.